focus, talk about some earnings candidates and get in touch with some managements then now. Borosil Limited is a stock that we wish to highlight right now. It's currently stock is 2.5% lower in today's trading session. If you take a look at the numbers, the revenue and EBITDA have seen a growth of 10.3 and almost 10% on a year-on-year basis. However, net profit has seen slight bit of a pressure, 4.9% or 5% thereabouts lower on a year-on-year basis. Let's interact with the management. Shreevar Kheruka, the MD at Borosil Limited, joins us. Good afternoon, Mr. Kheruka, and pleasure speaking to you on the show. And that's exactly what my first question is on your earnings, because while your revenue and EBITDA have expanded in Q3, your net profit has seen some pressure, falling almost 5% on a year-on-year basis. Last quarter, when we spoke to you, your net profit was rather flat, but this time it has fallen 5%. Help us understand what has caused this pressure on the bottom line since the last 2 quarters, especially since all three of your categories, if I take a look at all three individually, they have seen growth. So then what is weighing on the overall bottom line of the business?
Well, thanks for having me on the show. As far as the profitability, the PAT is concerned, we have in the last quarter of the previous financial year, commissioned a large borosilicate glass furnace, which has really increased depreciation substantially for us. So even though, as you rightly mentioned, EBITDA has grown, the PAT is down primarily because of a much higher depreciation expense. And that is likely to continue in terms of higher depreciation expenses for the next few quarters. But the reason to do that was to further enhance the Make in India theme. We have done some import substitution where we used to import certain products, and now we are making this in India, in Jaipur, and therefore that's allowed us also to grow product range and also the combinations that we offer to the market. So revenue growth is what we're really looking for. We can absorb the higher depreciation for the next few quarters.
Hi, good afternoon, Mr. Kheruka. This is Shristi also joining in. But taking a look at your margins, Mr. Kheruka, I believe that the last time we interacted, you told us that you are aiming at a 20 to 22% EBITDA margins over the next couple of years, which seems to be a bit stagnant at close to that 17.5% over the last 2 quarters. Help us understand how much more time it will take you to reach there, and in the next couple of quarters, how can we see the numbers panning out and going in that direction?
Yeah, I mean, look, the medium-term target, which was indicated, remains unchanged. There have been, reasonable headwinds, I would say, from a consumer demand perspective in this year, and that's probably evident across the industry. So, the revenue growth has been a little bit lower than what we ourselves had targeted, and that also obviously leads to lower operating leverage. So the margin expansion will come from more operating leverage, and we I think need some, let's say, tailwinds over there to help us see higher demand increases. Quite specifically, I would also say that this year, our institutional sales have been lower. Corporate gifting has been lower, and therefore, there was one segment of the business which didn't do well at all. And we do hope that we'll see some recovery going forward as sentiment improves. So that's the main reason for, let's say, flattish margins. On the other side, coming to a medium-term picture, I do believe that there will be rebound, especially this budget allows for higher, say, savings in the hands of the taxpayers, and that should lead to some consumption growth, we hope. And once that happens, I believe margins will go closer to the 20-22% kind of level, and I think that'll happen over the next 2 to 3 years. We're not too concerned about it in the short run, but I think the medium-term impact will be in the positive direction.
Okay, that's sounding optimistic, Mr. Kheruka. Also help us understand what's happening on the capex front, because when we interacted with you last quarter, you had told us that roughly 20 to 25% of the capex, of the 100 crore capex that you had planned, only 20 to 25% of that was left last quarter. What's the update on that now? How have you allocated that, if at all? And are you planning any fresh capex anytime soon?
So actually, our capex was a lot more. It was overall about 450 crores and then another 100. So in the last 2 years, we've done about 550 crores of capex, and that's all finished now. So we've fully concluded the capex cycle. We do have new projects in play, which we will communicate in the short, more again on the Make in India theme. So we do plan to expand the product portfolio that we manufacture in India, and therefore we will do some more import substitution. That capex has still not been yet approved by the board. We're working on something, and as soon as I'm able to say it, I can give you more details around it. But I do expect some capex in the upcoming quarters.
All right, but taking a look at your non-glassware category, that does this still remain to be the largest contributor in your overall revenue? Give us some sense there, and what kind of a growth you are seeing in the glass space, and what's the contribution between the categories and the outlook on the overall business?
Yeah, so the glass, we've seen a larger, let's say, trend on moving away from plastic to glass, and that's something that we've benefited from, and in some sense, we've been driving that trend as well. And if you see the numbers, ever since we started the production of our new furnace in Jaipur, we've got our glassware growth has been, quite substantial. In fact, in this year, glassware has been driving the revenue growth. I think almost 23% we're up in the first 6 months, or first 9 months rather. So glassware, we have to give customers really options, more designs, more products, more combination sets, and at different price points. And we've been working quite hard to do that. So I am very bullish on this, the increase of glassware sales over the next few years. It's a long-term trend, in my opinion. I think that's likely to continue, and we're very under-indexed as a country on usage of glassware when we compare to other countries, even middle-income countries across the world. So I believe there will be a growing usage for glassware. The health benefits are substantial. There are many other let's say benefits of using glassware, including the food is fresher and it tastes better, it doesn't smell. So there's so many benefits of it. So I believe we are investing more, and we will likely invest more in the future in glassware.
That sounds good. Also, could you give us an idea of how your channel mix is shaping up? Because we have seen emerging trends in e-commerce coming in. On the back of that, are you shifting more of your distribution towards e-commerce and online platforms? What's the overall mix looking like?
See, the strategy of the company is to get our products to the end customer. Now we are agnostic as to where the end customer buys. So if the end customer wants to buy on e-commerce, then so be it. We must be there. If they're going to the trade channels, we must be there. So we have set up our company to service the end customer, and the channels are the choice of the end customer. So therefore, we will be in all the channels where the end customer is. So I can't say that it's a strategy to prioritize any one channel over the other. I think the strategy is to prioritize the customer, and therefore we will move where the customer moves. And in general, yeah, there have been trends since COVID of more e-commerce growth. But I do believe that these are ups and downs. Eventually, customers also want to feel the product, touch the product. So the trade growth will be also significant. Growth in large format stores will also be significant. And those people who want convenience, will buy on e-com or quick com. So we must be everywhere, and that's really the goal here.
All right, but with this, we'll let you go on that. Thank you so much for taking the time out and speaking with us, and also sharing the outlook for the upcoming numbers for Borosil Limited. But with